There are a lot of people online pumping Amazon as a great investment, but is it really worth your hard-earned money to invest in this company right now? In this video, we'll look at both sides of the coin, the pros and the cons of investing in Amazon today. And at the end, I'll give you my honest opinion about whether or not I think Amazon is really a buy or if you should just leave it to die. Hey folks, thanks for tuning in. First things first, I'm not a financial advisor, and this video is for your educational and informational purposes only. Today, we'll analyze Amazon. Let's get right to it. So, how does Amazon generate revenue? Everyone knows Amazon is an online retailer, but it's much more than that. What's great about Amazon is that its revenue stream isn't limited to its online retail business. In fact, every year, people spend millions of dollars on services like Amazon Web Services cloud computing platform and subscriptions, such as Amazon's Prime membership, Prime Video, and Prime Music. Yes, Amazon's main revenue stream comes primarily from its retail platform, but the company's revenue growth comes from multiple secondary revenue streams. In addition to online retail, Amazon is seeing high revenue growth in its third-party seller services, cloud computing platform, subscriptions, and physical stores. So, what are the pros of buying Amazon today? The first reason you might want to consider buying Amazon is number one, Amazon Web Services. Amazon Web Services cloud platform is a dominant revenue generating machine. In Amazon's most recent earnings call, projects like AWS exceeded expectations for revenue and operating income growth, leading to further speculation about its future impact on Amazon's bottom line as its cloud computing platform continues to develop. This could be attractive to investors who are looking for a stable cloud business rather than simply an online storefront with a growing number of products. And the AWS division is growing rapidly, currently controlling about 1/3 of the global cloud market. AWS competes primarily with Microsoft's Azure and Alphabet's Google Cloud. If AWS continues to take market share, it will add to its already impressive economic moat. Number two, Amazon Video and Music are overtaking the competition. Amazon keeps on expanding. They're now growing faster than anyone else in the online video and music industry, which were once dominated by companies like Netflix and Spotify. Amazon Prime is growing at an enormous pace, plus over 200 million people have already signed up to Amazon Prime. That's a ton of opportunity. Consider this, Amazon Video controls about 19% of the streaming market. Netflix controls about 23%. If the number of Amazon Video subscribers continues to grow at this rate, then Amazon Video could overtake Netflix as the number one streaming service. And what's more interesting is that they're getting serious about podcasts. Just recently, they launched their own podcasting platform, which will only continue to grow as they add new features and improve services. This presents Amazon with another advertising revenue stream should the podcasting platform take market share. Number three, Amazon has a massive economic moat. Amazon's business is surrounded by a moat that has been ever so widening since its initial conception. Amazon's business model is solid, and its moat ensures that this company can endure even the worst of economic downturns, recessions, or bear markets. That's all well and good, but what are the reasons to avoid buying Amazon at this level? Number one, the Fed's interest rate hikes have a negative effect on growth stock valuations. This is the reason we are finding so many growth stocks trading at big discounts. When interest rates rise, valuation multiples fall, and investors will only buy stocks at lower and lower valuation multiples. Look at this chart of the 10-year Treasury yield. Notice in the 80s to 90s, we had ridiculously high interest rates. Now compare this to the historical price to earnings ratio of the S&P 500 stock market index and notice that the price to earnings multiple was at its lowest historical average during that time period as well. Amazon is a growth stock, and Amazon's annual earnings per share growth rate for the past 5 years is 68%. Now we have the Federal Reserve aggressively raising interest rates. How high do rates have to go to stop inflation? Will rates rise further than expected, putting greater than expected pressure on Amazon's valuation? If rates continue to rise, how much lower will investors value growth stocks? The number one con of investing in Amazon is this: we don't know how high interest rates will go, so we don't really know where fair value lies. This risk is real, but it's not the only risk. Number two, rising costs will cause Amazon's retail segment to struggle. Amazon's online retail segment has proven to be competitive and profitable. They have grown tremendously, but they are beginning to experience the same problems their competitors have: rising costs. Their growth during the pandemic was highly inflated due to consumers shopping online much more frequently. The positive results of the pandemic are now starting to reverse, causing e-commerce sales on Amazon to decrease. Rising gas prices harm Amazon's margins, which means Amazon will have to rely on its secondary revenue segments in order to maintain profits as it works through current market conditions. With the pros and cons out of the way, let's move on to valuation. Amazon's share price is down almost 40% year to date, leading many investors to believe the stock is cheap. If I look at Amazon's average price to earnings multiple over the last 5 years, I get an average multiple of about 75. Currently, Amazon's price to earnings multiple is 52, and the forward price to earnings multiple is 40. And if we look at the average price to sales ratio, I get an average multiple of 3.6, with Amazon's current ratio at 2.26. So, yes, Amazon looks cheap compared to its 5-year historical averages. So, what do I personally think of Amazon here? I love Amazon as a long term investment. Amazon's wide economic moat and growth prospects are attractive, but on a macro level, we've got a lot of big economic problems right now. Inflation and rising interest rates are causing a great revaluation of most stock investments. Consumers have less discretionary cash to spend. Stocks are in a bear market. Until these economic issues are resolved, Amazon could be valued significantly lower by investors than what we see in the current multiples. So for me, Amazon is on my watch list, but I'm not ready to buy. For those of you that are dollar cost averagers and can't wait to start a position, I'd consider Amazon in the $82 to $96 price range, where I'm seeing significant support at that level. But as always, I'm not a financial advisor. If we hit that level, I will reevaluate Amazon before I personally decide to start a position. Thanks so much for watching. Let us know in the comments below what you thought of the video and any suggestions as to what you'd like me to cover in my next buy or die video. Plus, if you want access to my best market analysis, trade ideas, model portfolios, or free stock market e-learning course, please register for our upcoming membership launch at conquerwallstreet.com.